Hey everyone, so in this video I want to talk to you all about the total return formula, what it is, how I've used it as a successful property investor, how it's helped me to grow and how it's helped my clients to grow their property portfolios successfully over the years as well. In case you don't know me, my name is Richard Norris. I've successfully built a multi-million pound property portfolio. I've been investing in property for the last 10 years and I've helped over 300 clients to build and scale their property portfolios too. I'm passionate about property, business, finance, health and fitness and all of those things. So the reason why I created this channel is because I want to inspire as many people as I can. I want to make a difference. I want to contribute. And fundamentally, I believe the fundamental reasons why 99% of people never reach financial independence is because they don't have a high level of financial literacy. Now, it's not your fault if you don't have a high level of financial literacy. I didn't either. Unless you take a conscious effort to go and learn it, you're never going to understand it because they didn't teach this at school. So one of the fundamental reasons why I created this channel is so that I could help you learn financial literacy and teach you some of the things that have helped me to create wealth in my life and continues to help me create long-term wealth in my life, and hopefully it may help you too. So let's jump in. What is the total return formula and how do we use it? So let's say, for example, because we're going to do some calculations now. So let's say, for example, we bought a property for £200,000, okay? So we bought a property, we paid £200,000 for it, right? And we took out a mortgage on it and the mortgage was £150,000, right? So in this example, we got a £50,000 deposit. So we're going to put 50k deposit over here, right? And then the rent on the property that we get per month, so the rent on the property per month is £1,000. Okay, so £1,000 goes here. And therefore that's 12, if we times that by 12, that's £12,000 a year in rent, right? Now, let's say, for example, on this property that we took out an interest-only mortgage and the mortgage was just £300 a month. 300 times 12 is 3,600, okay? So now for the purpose of keeping things simple and to not go too granular, I'm not allowing for taxes, I'm not allowing for management fees such as like letting agents fees, and I'm not allowing for things like monthly operating expenses, which would notoriously be things like your buildings and contents insurance and utility bills, dependent on the strategy that you use as a property investor, whether they're applicable or not. So again, for the purpose of the video and to keep things simple, I'm just going to go high level and use rent minus mortgage to kind of make the point that I'm trying to make and how the total return formula is very useful as a property investor and why we need to use it. So we've got a rent of £1,000 times 12 is 12,000 a year. We've got £300 as an interest-only mortgage times 12 is 3,600. So if we look at this then, on a monthly basis, we're making £700, right? And if we take the £700 and times that by 12, we make a gross rental income of £8,400 a year. Now, in order to calculate something that we call our return on investment, what we do is we take the gross rent of £8,400, okay? And we divide that by the money left in the deal. So in this example, it's just £50,000. We're just using the deposit, and again, I'm not allowing for things like legal fees, stamp duties, and all of those other things because I want to keep things simple again to make the point that I want to make. So 8,400 divided by 50,000. So that's the calculation that we use, and then we take the 8,400, we divide it by the 50,000, and then we times it by 100 so that we can work out what is our total annual return as a percentage. So in this example, if we take this 8,400 divided by 50,000 times by 100, it gives you a 16.8% return on investment, okay? Now, as a property investor, specifically, I use stumbled over my words there. So I use something called the return on investment formula to analyze the amount of net cash flow that I'm getting from a property. Now, if you're already a property investor, you'll know that most property investors typically would like to achieve a return of around 20 to 25%. That basically means that in 4 to 5 years, the property doesn't owe me anything. That's my break-even point. In 4 to 5 years, the property's paid back the £50,000 from the returns that I put into the property on day one in this example. Now, if I was just looking to buy properties that gave me a 25% return, then this property would not I wouldn't buy it basically, because the 16.8% is lower than the 25%, so it doesn't hit my margins. So I'm not going to buy it. Now, this is a mistake that I see a lot of investors make, and it was a mistake that I made really early on in my journey until I learned all about the total return formula and why it was super helpful, because the total return formula accounts for capital growth. Now, in this calculation up here, in this calculation that we're doing up here, in this calculation here, where we're getting 16.8% return on investment, it doesn't calculate for anything to do with capital growth. Now, you're going to see the difference when I start to look at capital growth and how that really contributes and actually helps us to make better decisions going forward. Now, a lot of people don't allow capital growth in their calculations because it's kind of like a hypothetical, unknown variable, and it's not guaranteed that you're going to get any capital growth. But if we look at the long-term appreciation of property, actually most people's wealth built over time, it actually comes from the long-term appreciation, the long-term capital growth of properties going up over a long period of time. So I kind of feel like we do need to account for it, even if it's kind of like a hypothetical number. I think that it really helps me to justify my investments, and it really helps me to look at all the variables to help me make better decisions. And hopefully this will help you to make better decisions with your investments too. So let's say that we, again in this example, what we're going to do is we're basically going to take the 200,000, so take the 200,000 pounds, and we times that by an appreciation value. Now, that appreciation value is the value that we think the property is going to go up by. So let's say that we think the property is going to go up by, let's say 3% in this example, right? So we're assuming that the property is going to go up by 3% in the next 12 months. So we take the 200,000 pounds and we then times that 200,000 pounds by 3%, which is going to give us a total annual appreciation of £6,000. So we're effectively saying that we think that this property is going to be worth £206,000 in 12 months time, right? Okay, now and you can see it's quite conservative, like it's pretty realistic. No matter really where you are in the country, you're really gonna maybe see a 2 to 3% return. Okay, so let's take the previous return of 8,400 a year. So we take the 8,400, which is our net cash flow from the property, and we add into that formula, over here, we add in an appreciation of £6,000. Now, what that equals is 8,400 plus the 6,000 gives me 14,400 as a total return on this deal. Now, if we take the 14,400, so we take the 14,400 and we divide that by £50,000, you can see that our return actually is 14,400 divided by 50,000 times 100 gives us a total return of 28.8% as a total return on our investment. So if I was to look at this deal in 12 months time, this deal was giving me a 28.8% return. Now you can see in the previous example I didn't allow for that and it only gave me a 16.8% return. So in fact what we've missed off here is we've missed 12% return by not allowing for the capital growth. Now again, if you're just an investor that purely invests on net cash flow, purely looking at cash flow and doesn't account for capital growth, that's also fine to start your portfolio off, but it also limits you to the deals that you're actually getting, because if you don't allow for the capital growth of the property, then you're really missing out. You're missing out considerable returns by not including it in your calculation. And this is something that I realized. So I just wanted to share it with you. I hope it helps you. I hope you found this video helpful. If you did find this video helpful, give it a like. And if you haven't subscribed to my channel already, hit the notification bell, hit subscribe. And leave any comments in the below if you want to find out more about this formula, how it works, and if you've got any questions, I'll be happy to answer those in the comments. So thanks for watching. See you soon.